The question of the day. Now, there could be more of a shakeout coming. I was talking to George Deere of RBC Capital Markets, who says he's not seen anything like this in 40 years of trading. An incredible statement from him. And the panic really started on Friday. You had Fed members been talking more forcefully about pulling back on QE. Inflation not really materializing. Cyprus might sell its gold, and Goldman Sachs saying to short the metal. So a quadruple whammy for the gold market. Now, our friends over at Bespoke crunched the numbers and found that since 1975, there have been 13 bear markets. Now, from the beginning of the bear market to the bear market low, the average decline is over 14%. So if that trend continues, it would push gold down to $12.81 an ounce, which a few months ago would have been unthinkable. Now, the theory among my sources is that there are some big institutions in the market perhaps selling. Remember, Cyprus might be looking to offload about 10 tons. And the down move that we saw Friday morning triggered some sell stops where traders are forced to sell to protect profits. Now, George Deere was saying that there are margin calls in the market. So that momentum here, Eric, really accelerating.
What about the physical market, Alex?
Right, and that's an interesting point. It's really the wild card. Typically, Asia jumps in when prices do dip, and jewelry buying represents about 45% of demand versus, say, investment at only 30%. Now, the lion's share of jewelry demand comes from India and China. UBS saying there was a pickup in Indian buying on Friday, more than twice the average daily demand. But China was mysteriously absent. But either way, it might not be enough to make up for the recent wave of investors selling. On paper, Eric, Friday, a good 1,140 tons of gold changed hands in the futures market on the COMEX. It is more than the total annual demand of India or China.